Hello and welcome to the 2022 recap and the 2023 outlook. This is Luke McCarty with McPherson Financial Group. And before we get into some of the slides, it was a historic year in the stock market last year, and the historic side is the historically bad side. So I'm going to let you guys know what changes we made last year, what we're going to do this year going forward, a little bit of our outlook, talk some of what the experts had predicted for 2022. It seems more and more that since 2009, the stock market is more focused on the Federal Reserve and the liquidity in the market. As the Feds added $9 trillion of debt from, some of their quantitative easing functions since 2008 and 9 up until now. A lot of that was COVID. Some of that was 08, 09. There's a lot of things in between. And in general, right, the government spending has a larger impact on the stock market than it ever has before. But that's probably because we are spending more money than we ever have before. So let's dive in. So this is our annual performance for 2022 from the stock model down to the equity income balance model. You can see here on the far right is our averages over time. I didn't put these in the model into these presentations before, but now we have 6 years of returns for every one of our models. Last year the highlights was the covered call down about 1.5%. Down to the equity income balance model, down about 5.5%. If you look at those, compared to the averages, for a balanced portfolio, equity income balance, we're more than almost doubling the benchmark, where our stock model is still outperforming, even though last year was a difficult year. The S&P 500 was down about 20%. The NASDAQ was down 34%. The bond market was down 13%. So it was a historic year for the markets in general. And these are some of our performance from individual stocks and the equity income balanced. When we go to more of our mutual fund ETF models, over time still outperforming the benchmarks. You can see here, the best performer here, the municipal income or multi-asset income. But you can see there were some struggles in the market here because these do own some bonds, they own some stocks, but overall the averages are still well above the benchmarks over time. So economic indicators, over 2022, there was a lot of talk of, are we in a recession? What's the definition of a recession? One of our main indicators for a recession is unemployment rate, right? Well, unemployment rate's actually going down, right? It's 3.5% as of December. It got up to about 3.7%. If you remember back in the August timeframe or the summer timeframe, Jerome Powell came out, he was in Jackson Hole giving a speech, and he pretty much ripped up the speech that was prepared and came out and said, some of you are going to lose your jobs, but if some of you don't lose them now, more of you will lose them later. That was another downturn in the market and another change from the Fed. I'm going to show you some charts on the Fed's expectations and estimates of what they thought they were going to raise rates by last year versus what they did. And it is a big 360. Makes us almost feel like the Federal Reserve doesn't know what exactly they're going to do. If you remember back to early last year, it was, oh, don't worry about inflation. Inflation's transitory. We'll raise rates a little bit. Things will be fine. Well, they raised rates a lot and a lot different than what were expected. But, from these economic indicators, right, housing is getting hit really hard because the mortgages went from 3% to, now around 7%. Real personal income, I've said this one quite a bit, if you haven't kept up with inflation, which peaked at 9%, it's coming down. But if you didn't get that large of a raise, you have less money. Retail sales, this is coming out. There's a lot of reports recently just out of December. There's some bankruptcies going on. Bed Bath & Beyond potential bankruptcy. Macy's had a really bad year. Lululemon, dropped about 12 to 13% in one day. So retail is getting hit. Part of that is we think the consumers running out of, dry powder, right? The consumers running out of the money that was saved, from the COVID timeframe, from the PPP loans to the stimulus checks to all the liquidity in the market. And now with things rising in prices, there's a lot more credit card debt. Houses cost a lot more money now. The price of houses haven't really fallen that much, whereas the interest rates have rose, significantly, doubled, right? Industrial production still holding strong. when we look at these indicators, right, if 4 of them go negative, that's kind of where we were in 2008 and 9. They were actually all negative, but 4 of them triggered and the 5th one triggered. So we're seeing things soften a little bit in the economy as the Fed's raised rates historically at historic levels, or historically fast, I should say. So this is a concern we have going into 2023 is, will the Fed induce a recession, cause more job loss to help fight inflation? So speaking of 2022 and how historically bad it was, the left is the S&P 500. We had the 7th worst year ever in the S&P 500. It was the worst year since 2008, right? It was 2008, then 2002. Then you go back to the 70s and then the 30s. You can see all of these have a different reason, have a different name. Art and I talked quite a bit about on the radio show, how do we avoid the next recession or next downturn? It's coming, but it's just going to be called something different. This one, according to this chart I found, is called the Great Inflation, right? The Great Inflationary Period of 2022. So the far right here is the worst years ever for a 60-40 portfolio. So 60% stocks, 40% bonds. This is the 3rd worst year ever for a 60-40 portfolio, right? That's because the S&P was down 20, the NASDAQ was down 34, and bonds were down 13. Usually, history tells us in a bad stock market, bonds, tend to rally, right? The flight to safety. That did not happen last year because of the Fed raising interest rates. So the 3rd worst year ever in a 60-40 portfolio, the 7th worst year ever in the S&P 500. It was a historic year. Take a deep breath. Let's find ways through, to navigate through 2023. And I'll kind of show you some changes we made and what we're thinking for 2023. But before we get to 23, let's look back at the forecast that, all these big firms had for 2022. So these forecasts were made in December of, 2021, right? And anywhere from, 4,400 on the S&P up to, 5,300 was the high. But I mean, we're talking, Bank of America, Goldman Sachs, JP Morgan, Morgan Stanley, UBS, all the big names, all overdid their estimates, right? Because the S&P finished at 3,839. So what that tells you is last year, based on the guidance of the Fed, based on the economy, based on where things were, almost everybody got it wrong from the big names of what the forecasts are. So we don't necessarily want to follow forecasts or even make our own, but this is what the chart looks like for last year versus the expectations. 2023 has a wider dispersion of estimates, and they're a lot more bearish, right? There's a lot more coming in lower than 3,800. There's still, of course, some coming in higher, which is always a possibility in the markets. It's always unknown, but to put these forecasts out there is pretty bold. I would think over time, these firms would, more than likely stop doing this as they continually get them wrong. So here's kind of, what happened. And as I mentioned, the Federal Reserve dictating the moves of the market with liquidity in the markets. This was the forecast from December of 2021. So we really didn't have an interest rate in December of 2021. The expectations were the Fed's going to raise about 1%. And that's down there on the right, the blue lines versus the green lines, and then kind of get us up to, 2.5% long run, federal funds rate, going into 2025 and 26. Well, if you look at this chart, and then after I show you the next one, rewind it and go back and forth, you'll see the huge difference in what the Fed told us, what the market told us versus reality. Here's reality. So not only did we get above 1% in 2022, it got to 4.38%, and it got there fast. So now what the market's telling us is, maybe 0.25%, maybe 0.5% hike this year, but the Fed's come out pretty strong and said, nope, we're going to get in the 5s. And so if the Fed, keeps going this direction, history tells us as we look back on this chart, every time the Fed raises rates, there's an event, right? If we go back all the way to the left in 99 and 2000, right? Then you have the tech bubble, right? Then they started raising rates into 2006, 7, and 8. Then you have the subprime mortgage crisis. 2018 and 19, the market was down pretty big Christmas Eve of 2018 until the Fed stopped raising rates. So you kind of see the stair step up and then the elevator down. This one feels more like an elevator up, and we'll see what the Fed does in 2023. I think consensus with us is, the Fed saying they're going to 5, unemployment's still low. There's going to be some interest rate hikes coming up, which more than likely means that, your mortgage rates potentially are going up, CD rates can follow, money markets will go up. We'll have to find some different alternatives in the cash space. Here's some changes we implemented last year into the stock model late in the year. So when we look at this chart, you want to be in the green, right? You do not want to be down here on the far left of the yellow. So right now you want to be in Caterpillar, you want to be in Merck, you want to be in Travelers, far right's Boeing. Boeing had a tremendous bounce off the bottom. Kind of this white section is kind of no man's land. You don't necessarily have good momentum, but you don't have bad momentum. And on the left here, kind of in the yellowish, is where you don't want to be, right? Intel's kind of the worst. If Tesla were in the Dow, it would be bottom left corner, down 65, 70%. But you can see there on the far left, Apple and Microsoft. So some of the generals of the market, as we call them, generals of the S&P 500 have started taking a hit. Apple, Microsoft, Amazon, Google, they're not all in the Dow, but they're down about 25, 30%. And so when we're looking at this, right, we're going to pick the top 15 Dow stocks based on momentum. This will be in the stock model or any of our models that own stock. We're going to have a tighter leash as we see a lot of volatility coming this year. We're going to manually exit positions if anything falls 15% in the quarter, and we're going to have a quarterly rebalance. So if you're in the stock model or in one of our models that own individual stocks, you'll notice some of these names in the green. Whereas we got out of the ones kind of in the far left, Apple, Microsoft, and things like that. So some changes to help reduce risk, but there are still places to be. You can still make money in a bad market, even in a bad economy. We're just going to have a tighter leash and, reduce downside in our stock model. Our 2023 outlook, there's still the inflation concerns. Inflation appears to be coming down pretty quickly. But will the Fed continue to raise rates, right? Powell has already came out this year and said there will be no rate cuts in 2023. So a lot of analysts and a lot of the big banks and the big investment firms were kind of saying, hey, the bond market's going to rally, the Fed's going to pivot. Well, Powell basically has told us he's not pivoting. He's staying flat. We're not going to cut rates. Their inflation goals are 2 to 3%. So what that means for us is we need to be careful in the growth section of the stock market, right? We need to continue with our bond alternatives, like annuities, preferred stocks, right? Prospect Capital will pay you about 6.5% with no price fluctuation. Strategic storage is a different type of alternative where you can earn about a 6% dividend with upside growth. This is a company that's revamping mom and pop self-storage units and kind of institutionalizing them. When we look at this sector of the market, it feels where, multifamily housing was about 10 to 15 years ago. And we know how well that's performed over the last 10 to 15 years. We're going to continue hedging. We added in a new position as an ETF, XDECX December. This is the S&P 500, but we have about a 15% buffer on the downside. That gets us potentially down to 3,400 on the S&P. With a 15% cap on the upside, right? So we can have downside protection and still make a good upside return on the S&P. MBXIX is our Catalyst Melbourne hedge fund strategy. This fund has the ability to earn a positive return in both positive and negative markets. So it's part of our hedging strategy now. And we're still short the S&P in some of our models, as we see a lot of volatility, as we see, potential in the market coming early this year of, earnings estimates, earnings revisions. The retail got hit hard in November, December. There's some, big names, with bankruptcy looming, Bed Bath & Beyond, Lululemon didn't do very well. Now Lulu's not going bankrupt. The $120 leggings are still in play, but there's a lot of concern in the retail space as consumers are, running out of cash and going on credit. We're going to stick with short duration, high yield bonds. This MDHIX is mainstay. It was down about 3% last year as a bond fund, while the bond market was down 13%. So it held up really well. and cash alternatives, right? Beginning of last year, there was really no alternative to cash because money market wasn't paying because the Fed was at zero, right? The interest rate was at zero. So now money markets are paying, 3.9 to 4 range. You can get a CD in the fours, and you get fixed rate annuities in the 4 to 5% range. So there's places to be. It's a lot dependent on what the Fed does going forward when it comes to bonds, when it comes to cash, when it comes even to the stock market. So some more outlook from us, expect more videos and communications from the team, including our in-house CPA, Mark Bernard. He's putting together a video on taxes in the new Secure Act 2.0, which is the hidden retirement agenda in the 1.7 trillion spending budget that got passed around Christmas. Some of that is going to be, RMD ages going up, your ability to save in different accounts, or, your limits are going up. As we say this, right, our government's $31 trillion in debt. So we still feel like taxes are going up in the future. Mark does a really good job with our clients, doing their taxes, of course, but also doing a lot of tax planning. So if you have some tax issues or need help on the taxation side, please contact us and we'll get you in touch with Mark. You can also receive notifications by subscribing to this YouTube channel, to get these videos along with the weekly podcasts. Art, myself, Julie, Mark, we're on the radio weekly, and these are cut up into podcasts that get posted to YouTube or Spotify or Apple. We're also going to be holding several client events throughout the year, right, including some par 3 golf tournaments at Duran Golf Club, some movie events, some brewery tours. We always have a shredded event here at the office. The food truck last year was a big hit. We'll head down south and do something at Big Shots, as well as a Christmas open house. So there's a lot of ways to receive communications from us, or to do things outside of the market events and have a little bit of fun. So thanks for watching the video. I'm Luke McCarty. You shoot me an email or Art. There's our office line. And we look forward to 2023, and we will continue making changes to the portfolios on your behalf.